Hello, friends. Today we are going to talk on the topic why did the Fed cut the interest rates? And also, we need to see today that if the Fed cuts the interest rates, how does it impact our Indian market? Because as you are the investors, you need to know that will it impact our Indian economy or will it boom our economy? So, let's dive into what's happening with the Federal Reserve or the Fed, the central bank of the United States. As in India, Reserve Bank of India is the central bank of India. In the same way, the Fed Reserve is the central bank of United States. The Fed has a huge impact on the economy. And one of its main tool is adjusting the interest rates as our RBI also adjusted the interest rates. Think of interest rates as the cost of borrowing money. When rates are high, borrowing becomes pricier, which can slow down spending and the borrowing. For example, if I go to the bank and I ask for the loan and they increase the interest rates, so now the borrowing would be expensive. And when they decrease the interest rates, it would be very much cheap for me to take the loan from the bank. Now, when rates are low, borrowing gets cheaper, encouraging people and businesses to spend and invest. These rates change directly affect inflation, job growth, and overall economic stability. As you can see, whenever the rates are low, this induces people that they borrow the money from the banks and it affects the inflation. As the people are having more purchasing power, they would be spending more money in the economy. Also, talking about the job growth, since the industries can now get cheap interest rates, so they would also increase the employment growth, and overall economic stability also increases whenever the rates are low. Recently, the Fed has cut its interest rates by 0.25%, bringing it down to a target range of 4.50 to 4.75%. This follows a 0.5 percentage cut in September, making a total reduction of 0.75 over the last few months. So, why these cut rates? The Fed's trying to balance economic growth while keeping the inflation, the general rise in prices under the control. Right now, inflation is slowing down. It's down to 2.1 percentage, a big drop from the 7 percentage we had saw 2 years ago in the US, showing that the Fed's previous rates hikes may have helped ease inflationary pressures. At the same time, the US economy remains strong. It grew by 2.8% in the third quarter, and consumer spending has stayed solid, reflecting people's confidence in the economy. Meanwhile, job growth has slowed a bit, but that's partly due to the factors like the labor strikes and natural events such as October hurricanes affecting certain areas. Even with this slight job market dips, the unemployment rate is still low by historical standards at 4.1%. Though it's a bit higher than last year, it signals a stable job market overall. Wage growth has also started to slow down, which aligns with the Fed's goal of keeping inflation around 2%. Essentially, the Fed aims for a steady economy where prices and wage rise at a manageable pace. In a recent press conference, Fed Chair Jerome Powell emphasized that the Fed's policy choices aren't swayed by political events, including the elections. This independence is key to the Fed's credibility. It allows them to focus on the long term economic health over any short term political agendas going on in their economy. Powell made this clear, even stating he wouldn't step down if asked by any president, and nothing that legally a president can remove the Fed leadership. So, this is a sense of credibility which we can see in the Fed Reserve. As the Fed cuts rates, there's a surprising trend. Bond yields have been rising. Normally, rate cuts make borrowing very easier, which tends to push bonds yields down. But this time, bond yields are going up. Powell suggested this might be a sign that markets are betting on strong economic growth ahead, rather than fearing just inflation in their economy. While inflation overall is down to 2.1%, core inflation, which excludes volatile categories like food and energy, is a bit higher at 2.7%. This difference is partly due to the housing cost, which tends to be slower to adjust. So, while inflation is moving in the right direction, there's still some work to do bring core inflation closer to the Fed's target. Powell used a helpful analogy to explain the Fed's approach. It's like landing a plane. As you get closer to the runway, you need to slow down and make careful adjustments rather than landing too quickly. The Fed is closely watching the data and plans to make gradual changes as needed in the economy. Powell also shared insights from conversation with business leaders nationwide, many of whom are optimistic about the US future. There's even hope that 2025 could be stronger for them as compared to the 2024, which has already been a good year for the economy. Still, they are saying that 2025 would be much better. Now, you would be wondering how will it impact our Indian economy? In theory, lower interest rates in the US are positive for the emerging markets like India. Lower US rates can lead the foreign investors to look for the higher returns in the emerging markets, known as the hot money concept in economics, which says that the investors are continuously looking for the areas, for the markets where the interest rates are high, where they can make their investment. This means increase in the interest rates would mean that the investments in Indian debt, equity, and other assets would increase for our Indian economy. Additionally, if US equities rise with lower rates, it often boosts the sentiments in global stock markets. That said, a Fed cut might put some indirect pressure on the Reserve Bank of India to lower the interest rates. But the RBI has been now very much clear that it prioritizes domestic concerns over the US rates, focusing on controlling the inflation in Indian economy and ensuring financial stability in the India. In practice, though, interest rates are just one factor and many elements drive the markets. Monetary policy matters, but it's far from the only thing influencing the economy. So we need to understand over here that whenever the market rates are higher, the interest rates are higher in the country, it explodes or booms the investors' mindset wherein they can invest in our economy. So the same way is working wherein the foreign investors are continuously looking for Indian markets for the debt and equity where they can invest their money and they can earn a good amount of interest from the Indian economy, right? The bottom line, the Fed is consciously optimistic, making careful adjustment, watching the data and ready to adapt its approach as needed. The economic outlook looks steady, but the Fed will keep fine-tuning its strategy based on how things unfold. So we need to see over here how the fight between the Fed, US, and the Reserve Bank of India would work. Because in India, the RBI is continuously prioritizing the way how the Indian market is going. And also they are prioritizing the domestic concern, but the US is looking for their economy. This has been always the situation that whenever the US is affected, India also gets affected and they lower down their interest rate. But this time, the RBI is not at all in a mood to lower its interest rates. So this was for our today's video where we have discussed how it would be benefiting the Fed cut rates for the Indian economy and how it will boost our Indian economy on perspective of debt, equity, and the rising markets. If you have liked our video, do subscribe to our channel and share it with your friends for more such insights. Thank you.